Hello there. Welcome to the Open here on BNN Bloomberg. Surging oil prices are, of course, at the top of our agenda today. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. The group of 7 finance ministers are set to discuss a possible joint release of strategic oil reserves as the Middle East war drives crude prices sharply higher. That call was organized by France, which holds the G7 presidency, and it could include coordination with the International Energy Agency, which is a grouping of big energy consumers. A release from global stockpiles could help ease supply disruptions that have pushed Brent crude, the world contract, close to $120 US a barrel. However, officials say no decision has been made. Prime Minister Mark Carney spoke with U.S. President Donald Trump yesterday afternoon, according to a statement from Carney's office. The leaders discussed the economy, developments in the Mideast, and trade relations. Both agreed to remain in close contact. Saudi Arabia has started reducing oil production as the near blockage of the critical Strait of Hormuz starts filling storage tanks. The cuts by the world's biggest oil exporter follow similar moves by the United Arab Emirates, Kuwait, and Iraq. Some of those countries have been turning production lower so as not to overwhelm storage too quickly and avoid a complete shutdown of output. The near standstill has clogged up exports, sending oil soaring and risking a spike in global inflation. U.S. futures under pressure amid the uncertainty of what these higher oil prices are going to do to economic growth and inflation. Let's see how the TSX ended on Friday. It, of course, has received a boost over the past couple of weeks from Canadian oil producer stocks climbing to record highs. And of course, something of a recovery in gold has also helped our gold miners. Let's have a look at North American oil. The WTI benchmark, you can see topping that $100 psychological mark for the first time in more than 2 years. And let's have a look at the Canadian dollar. Gold futures, I'm sorry, we jumped ahead there. Gold pretty flat today, but it's still above 5,100. Canadian dollar, let's see how our currency is faring in this choppy energy environment. Not doing too badly, almost 74 cents US. And finally, Bitcoin. Let's see how that big crypto is doing. It's holding in today, but of course, it's been a major disappointment for investors since last fall. You can see, though, trading in something of a range lately. Right, so we just saw oil topping $100 a barrel for the first time since 2022. Let's get more from Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Jim.
Good morning. How are you?
Very good. What's your main observation on oil at this stage?
Oil's a sell, gold's a sell, stocks are a buy. Right? You sell parabolic moves, and as we saw earlier, the chart is parabolic. Oil's in extreme backwardation. Isn't it interesting that Karg Island, the key Iranian export island, has not been touched? The Secretary of Energy was out this weekend saying that the Strait of Hormuz will be cleared up in a matter of days.
And Jim, let me interrupt you there. Backwardation is where short-term prices have soared relative to long-term prices.
Are extreme,
yeah.
Yes. So,
but you're saying a year out, oil hasn't really moved.
Right. And the same thing with the VIX or the volatility index when you have the near-term contract or the spot contract way above where it is out three months.
Yeah.
Typically, that means volatility is going to decline. And when volatility declines, risk assets start to appreciate. So I would be suggesting, and what I've been talking about, is you should be fading this rally in energy and in gold. And you should, be thinking about what's your shopping list, take advantage of the volatility. And I would expect to see some clarity in the near term.
And I kind of cut you off there. Sorry, you said the Americans are insisting they can clear the Strait of Hormuz.
the Secretary of Energy was on TV this weekend basically saying, give us a couple of days and that's going to be done. Mm-hmm. And so it's, it's a matter of insurance. It's a matter of clear passage. The U.S. military will take care of that. And then we get the flow coming back in. And then, Andy, what I think is very interesting and what the market's telling you is that the world is awash with oil right now. And that's why the G7 is talking about it. But I don't think we really need it. This is a fear trade. This is a view that this is going to escalate further. Mm-hmm. I don't think it's going to escalate further. I don't think the president is into regime change. I think he just basically wants the Iranians to stop sponsoring terrorism and stop attacking Israel. And we'll see with this new regime or this new leader what will happen. But President Trump is not a neocon. So I think cooler heads are going to prevail, and the market's going to look very different in the next couple of weeks.
It's interesting. You say that in Tel Aviv, the stocks have not been selling off?
No. And so we're here, like I always say, we're here clutching our pearls as of Friday. Tel Aviv was up 7% higher relative to the S&P 500. So maybe the Tel Aviv doesn't have all the algos freaking out on the headlines, right?
I guess one thing, of course, we get into military strategy here, but the Iranians could keep up a gadfly approach. They could have small patrol boats sneaking out and just sparking fear among shipping owners, and that could drag on for a while.
Sure, and the Iranians, if they were really serious about creating economic damage, they could blow up Karg Island. That's the whole thing. This island, this massive export island in the middle of the Strait of Hormuz, nobody's touching it, Andy.
Whose island is it? Sorry.
It's Iran's island, and that's where all the oil gets made. That is the main port and shipment area where the cargoes get loaded for the rest of the world. Mm-hmm. Nobody's touching it. So if we wanted to have mutually assured destruction, Andy, and you and I were gaming it, we would blow that island up in a New York minute.
I mean, it's very different from 73, 74 in that the Arab countries united to cut back oil supplies deliberately. And we're sure not doing that deliberately this time.
Exactly, but that's how we're framing it, right? Yeah. And it's not the Iraq war in 2002 and 2003. President Trump is not President Bush. They are not in for regime change. So, but yet what we do is we throw that on top. Everybody freaks out, $150 oil. And I would suggest to you at $100, if I said major war in the Middle East and $100 oil, you'd be sitting there going, well, I thought it was supposed to be 200 or 300. Same thing with gold. Gold is sitting there at 5,000. I thought with a major geopolitical crisis, remember, everybody's buying this for the geopolitical risk. Why isn't it at 6,000 or 7,000? Right? The smart money's fading this rally, Andy, and they're going in and picking off stocks that are on sale.
You have some stock ideas for us. Royal Bank of Canada, people should take a look at that, you think?
Yes, if Tiff Macklin is unwilling to cut rates, and if you look at the last quarter earnings, 17% increase in personal banking, that was caused by individuals renewing their mortgages. And so if they're going to be doing 2/3 of their mortgages this year. Royal Bank is a fee income juggernaut. It's pulled back to a nice support level. I would be picking at Royal Bank right here.
NVIDIA, you're interested in that one. Maybe we'll put up a one-year chart.
AI is, the U.S. is going to become an AI leader. People are not talking about how the U.S. military is using AI in the Middle East. This is a leader. You want to buy leaders when they're on sale and they're irrationally being sold.
And Goldman Sachs, you think, is going to do okay as well?
Goldman Sachs is right back to the 200-day exponential moving average, upward sloping. You want to buy, if you're in a secular growth and, a structural bull market, you want to buy the capital markets. And Goldman is a great way to play capital markets.
A friend of mine is very tech savvy. He was building himself a website. He said, well, he buckled and he just got Anthropic's Claude to do it. He said it was just incredible. Things that would have taken him days, he was doing in an hour. So stocks like Thomson Reuters have collapsed. And they've bounced back a little bit, these software names, data names. You think Thomson Reuters is a buy right now?
I like that, or a company like Oracle. What you want is you want companies that have data or intellectual property. And I love Thomson Reuters for their legal library. Yes, there's going to be bumps along the road, but they've all been the baby's been thrown out with the bathwater. And look, Andy, there's been a counter trend rally in software, in Bitcoin, all these companies that have been thrown out. And then there's other companies that everybody's piled into, like Walmart and Costco. The fear trade has gone too far. That's where the bubble is. Risk is perverse. And then when you have cannons going off and you're in war, you want to sell safety and buy risk. That's the objective.
Jim, thank you very much.
Thanks, Andy.
Jim Zorn getting the show off to a great start. He is Chief Market Strategist at Wellington Altus Private Wealth. Coming up, more on the shockwaves being felt throughout global markets with oil soaring above $100. And of course, that is pushing gasoline prices here higher. We'll have more after the break. The son of Iran's slain supreme leader has been named as his replacement by a panel of Shia clerics. And of course, apparently that's raising eyebrows among some in Iran. Didn't we get rid of a hereditary dynasty in the Iranian Revolution? Let's get more now from CTV's Scott Hurst. Scott, thanks very much indeed for joining us. Over the weekend, Iran has signaled that a new leader has been chosen, the son of the previous chap. And how does this play into the ongoing conflict?
Andrew, good morning. Really, the latest developments are inflaming an already volatile situation. A new wave of airstrikes is hitting Tehran after the Iranian regime launched more attacks on Israel and Gulf countries, hours after Iranian state TV said Mojtaba Khamenei, the son of the country's late supreme leader, as you mentioned, has now been named his successor, meaning the younger Khamenei will likely have a central voice and a central role in the ongoing war strategy. Now, in the meantime, as you are covering significantly, oil prices have since skyrocketed, leading to more concerns of higher energy costs fueling inflation, with Iran's stranglehold on the Strait of Hormuz, leading to G7 nations holding an emergency meeting to discuss the surging oil prices, which could mean dipping into emergency oil stockpiles in response to the soaring energy prices. And now, as we've seen, particularly for Canadians here on our shores, the ripple effect in the immediacy means we've seen higher gas prices. And so we're seeing these ripple effects right across the world on the broader economy because of the ongoing fighting in the Middle East, Andrew.
Yeah, it is. Wow. We're looking at an oil chart right now. I see oil actually, North American crude, slightly below the $100 level right now, but it's still up exponentially in the past few days.
And that has been, kind of one of the main drivers of this ripple effect right across the world, where we're seeing it firsthand for us here in Canada, hitting our wallets right away with gas prices going up significantly. Just one of the many factors and one of the ongoing concerns that this war that was launched by the U.S. and Israel targeting the Iranian regime will have continued effects right across the entire economy.
Scott, thank you very much. Really appreciate it.
Thanks, Andrew.
Scott Hurst of CTV News. Okay, up next, we're going to get Bloomberg Intelligence Senior Commodity Strategist Mike McGlone. Does he think that investors should sell out of this oil rally? That's ahead. Let's get more on this surge in energy prices. We're joined by Bloomberg Intelligence Senior Commodity Strategist Mike McGlone. Mike, thanks for joining us. What's your number one thought on oil? Is this jump in prices likely to be long-lasting?
No, Andrew, it's classic short cleansing, significant short cleansing. You really saw that in the front months. Both Brent and WTI peaked overnight at $119.15, the same price, which means that WTI, Brent took away that premium and it spread it out, which means it's mostly short covering. But you tilt over to the December contract in the U.S., it's $71 a barrel. That's significant because that'll be front month right before the elections. You have to be asking yourself, what's the propensity for these prices to go back down, which they usually do? And I'll point out one key fact. Right now, we have the surplus of U.S. crude oil and liquid fuel production versus supply running almost 8 million barrels a day. Now, that started to curtail a little bit as prices are going down, but now prices popped up. What do you think those producers are doing? They're selling forward on the curve, and they're going to bring on more supply. And unless there's some kind of major shock at the Middle East, rinse and repeat, prices go back down towards 50.
And that's a global surplus you're talking about there, Mike.
It's global, but it's shifted over to the Western Hemisphere. That's what's happened the last time we've had major bottoms in crude oil. So let's look at 2020. Now, that was because of COVID, but crude oil bottom, it went negative. But back then, the U.S. and Canada were running surpluses around 2 to 3 million barrels a day. Now they're approaching 8. You see the trend there is when prices go up, that supply comes most notably from the U.S., Canada, Western Hemisphere, all the way down to Argentina, Venezuela in there now. And it pushes prices back lower. So you have to have some kind of major shock out of the Middle East, which means major problem for China. And China is, exporting a deflation to the rest of the world.
Sorry, Mike, sorry to harp on, but you're not saying that Canada and the U.S. alone are running a surplus of 8 million barrels a day?
Yeah. We are. If you look at Department of Energy data, I've been using this one for 20 years. Andrew, I love it. But it's approaching 8 million barrels a day. And I put that in context. In 2008, when crude oil peaked at 145, that was a deficit around 12 million barrels a day for U.S. and Canada. That's how the world's changed. And that's why the center for price maker has shifted to the Western Hemisphere. Right now, this is a blip out of the Middle East. What does that mean? More supply from the Western Hemisphere, most notably U.S. and Canada.
But Canada produces about 4 million a day, maybe a bit more. And America is maybe, let's call it 14 million. So that's about 18 million. So how could they be running a surplus of 8 million barrels a day, those two nations, Mike? Or am I taking this up wrong?
Well, no, there's a data point on the terminal called U.S. net imports. It's negative 3.9 barrels a day. When they created this data 20 years ago, never thought the U.S. would be a net exporter. That's the paradigm shift. The U.S. is now a net exporter. Yes, there's different grades, but overall, there's a surplus of supply. The bottom line is when you're a producer and you're getting towards your break-even costs and prices pop up on that forward curve, you sell forward and bring on more supply. And that's what I fully expect we'll see by the time we get to the midterms, is lower prices.
Right. And the Trump administration has floated various things. Reportedly, I think it was the Financial Times said they mulled messing around in futures markets, but decided against that. They also thought about offering insurance, but given the current reliability of the current U.S. administration, I wonder would people be would be keen to have insurance backstopped by Washington?
Well, there's the issue. The number one issue is what I got wrong. I did not think they would allow the Strait of Hormuz to be closed, but it is closed, and we've spiked gasoline, crude oil prices to near 120. Now, the high in 2022 was 130. The high in 2008 was 145. You get the trend? The key theme also this year is natural gas prices were up 100% in January, and now they're down almost 10%. That's the front contract. That's potentially a guide for crude oil. We've seen this before.
Yeah, and we got into this with the previous guest. It's not like the oil embargo of the 70s when all the Arab countries deliberately restrained supply. This time they've been forced into it.
They're forced into it. The bottom line is you as a net exporter now, and that's what shifted. The Western Hemisphere is now the price maker, and this is going to make them bring on more supply.
What about food? What will it mean for food export markets, if anything?
Well, that's another thing. The U.S. and Canada are also net surplus producers of grains, most notably corn, soybeans, and wheat. Now, this is pumping up fertilizer prices a little bit. You saw that December corn contract got to near $5 a bushel last night. The break-even cost is near $4 a bushel. You know what the producers are thinking? Thank you. Let's sell little forward and bring on that supply at a profit. And if they don't, they might be imprudent because you have to have prices higher. And if we get just a normal production year, again, like last year, massive supply out of the grains. It's also from Brazil. So you see the trend there? We were heading towards low price cures. And now we pumped up prices. That's going to accelerate more supply into the system and maybe reduce demand.
What about gold, Mike? Would you be long gold at this stage?
No. I'm bearish gold. I'm done being bullish gold. Partly there was one announcer I heard on Bloomberg TV this morning mentioned gold and de-risking in the same sentence. The fact is gold 180-day volatility has jumped to 2.4 times the S&P 500. That is no longer a store value. Now it's a speculative risk asset. And I think as volatility trickles from gold to the stock market, everything potential goes lower. And the bottom line is before the invasion, gold was the most expensive ever versus the Bloomberg Commodity Index. Now we see commodities come back and gold's just too high.
Thank you very much. Really appreciate it, Mike. That's Mike McGlone of Bloomberg. This fighting in the Middle East has pushed up fuel costs and it adds economic strain to Atlantic Canada. CTV's Mariah Sarrow filed this report.
Across the Confederation Bridge, trucks move goods on and off Prince Edward Island year-round. But when fuel gets more expensive, going the distance does too.
It's going to drive grocery prices up for a number of reasons.
At Atlantic Beef Products, a meat packing plant on the island, trucking costs are already part of the pricing equation. So are oil-based packaging and propane for heating.
Price changes are not something that we're unfamiliar with. Sometimes they're up and sometimes they're down. These won't help keep prices down.
The company's CEO adds more costly freight could drive up what it charges wholesale buyers. The minimum price of diesel on PEI is at nearly 230 cents per liter, now the highest in the Maritimes, an increase of more than 19 cents this week, a cost that can quickly add up. The PEI Potato Board says the jump in fuel costs is bad timing for farmers preparing to plant their fields, after last season's drought devastated the crop. Some of the world's biggest exporters of key fertilizer ingredients are in the Gulf region, and any disruption there could hit growers here.
Those operations, which are nitrogen intensive crops, those prices are going to go way up.
On the water, the PEI Fishermen's Association says fuel is one of the top 3 costs for members, and any increase has a negative impact on their bottom lines and product costs. All of that adding up to plenty of stress and worry for islanders and tourists over their grocery bills.
Well, it's already expensive enough as it is.
Definitely paying more every paycheck, and it's eaten into whatever money I have outside of that.
If the conflict continues for weeks, international affairs experts say Canadians could see a serious return to inflation right across the board. Maria Sru, CTV News, Borden Carlton, Prince Edward Island.
Let's have a quick look at the markets before we go. The opening bells are coming up fast. You can see we're looking at a lower open for U.S. stocks this morning, at least judging by futures. As of today, the S&P 500 down 1.5% so far this year. The TSX Composite is up just over 4%. Opening bells coming your way. And there you have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, it's half point doing the honors. In New York, it's America 250. And at the TSX, it's the TMX Group itself opening the market to celebrate International Women's Day 2026. It's time for the first 50. Okay, let's check out some stocks of interest as we get trading underway on this Monday morning. As you can see, shares are down amid concerns over the disruption threatened by this surge in oil prices to multi-year highs. North American crude topping $100 US this morning for a while, then slipping below that level. One stock of interest, not energy related, Constellation Software, a favorite of many of our guests over the years, and then concerns about AI denting it and other software shares. The company just reported its Q4 numbers. Desjardins says they were in line with expectation. Organic growth, i.e. not fueled by acquisitions, slowed down sequentially to 2% from 3%. However, Desjardins says M&A post-quarter is looking solid. And so the market, it looks like accepting those Constellation software numbers. The stock has bounced off its bottom. But bounced off its low points. Let's have a quick look at a copper name, Hudson's Bay, or not Hudson's Bay, Hud Bay Minerals. You can see it's down. Now, JP Morgan is warning that industrial metals are in for more pain because as Middle East tensions escalate and oil prices spike. That's according to the analysts at JP Morgan. They've turned negative on European mining and steel stocks in particular, and they've downgraded a bunch. I'm not sure if the North American ones are in their targets here, but they're warning there's a threat here to global growth, and events in the Middle East are not being adequately discounted. Okay, let's get to some U.S. stocks on the move. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Thanks very much indeed for joining us, Jeff. Live Nation is higher because there's a report of a $200 million settlement with the U.S. Department of Justice.
That's right. The stock is one of the top performers in the S&P 500 this morning. It's up about 5.8% right now. That adds about $2 billion in market capitalization. As you mentioned, they have reportedly reached a settlement in a case that will pay out $200 million. They have been involved in this case, which has basically been an antitrust case. The settlement would potentially require Live Nation to allow rival ticketing offerings on its platform and shorten the kind of, I guess, shorten the exclusivity for Ticketmaster, which would then, of course, open up to more, more ticket offerings on the platform. I should say, however, the gains are pretty sharp this morning, but there is still a trial going on here. This settlement could pause the trial, but it would require the counterparties in that trial to settle as well and to make sure that that actually does go through. So a little bit tentative right now, but this is the top performing stock in the S&P today and definitely worth watching over the course of the session.
You're watching a couple of chemical stocks?
That's right. Yeah, obviously with the war in Iran, oil prices and oil are not the only commodities that are being restricted as a result of the kind of the choke point there at the Strait of Hormuz. So we have RBC Capital Markets upgrading a handful of chemical companies today. Dow is the big one, and LyondellBasell Industries is the other one. Both upgraded to outperform from sector perform. Both had their price targets rise fairly substantially. In this case, it's polyethylene. These are companies that produce polyethylene as well as other chemicals. Those prices are on the rise, and these stocks, according to RBC, could see a little bit of a boost. Should also caution here that we have seen maybe not the same level of strength as people were expecting in the energy and commodity sectors last week, even with the increases in oil prices and gas prices and related prices. Going to need to wait and see how the stocks react here.
Just looking at Methanex in Toronto up a little bit, MX, and also Nutrien, because, of course, there's been a major fall off in nitrogen fertilizer exports from the Gulf region. Thanks, Control Room. Methanex doing well. It tends to trade, methanol tends to trade in line with energy prices. And also we saw Nutrien moving up because this is going to tighten the fertilizer market. Thank you very much, Jeff.
Thank you.
Jeff Morgan of Bloomberg. Coming up, markets under pressure. Investors are worried about a prolonged conflict in the Mideast. That's ahead. Right, so the price of oil topping $100 this weekend. Investors are worried that this conflict in the Mideast could drag on. We're joined by Johnny Russell, Portfolio Manager in Global Equities at Amova Asset Management. Johnny, thanks very much indeed for joining us. We've heard from at least one guest today that this will blow over, that the oil price will come down. Is it factoring into your strategy at all right now when it comes to picking stocks?
Yeah, well, we'd probably expect that as well. So history would suggest that when you get a spike like that, you sell into the spike rather than actually go after it. We're long-term investors as well, so we need to consider what the price would be longer term.
Yeah.
So really thinking about the fundamental supply and demand. So it does impact how we think of the risk around portfolio, but actually it throws up opportunities in other parts of the market, and that's where we're looking for ideas.
You reckon, you and other observers say there has been this major shift out of the AI hyperscalers into other stocks.
Yeah. I mean, it's like shoving an elephant into a small jam jar. It's so much money. It's the 650 billion plus for 2026 in terms of that capex being spent across industrials, materials, some energy, power markets, cooling for data centers, construction. There's a long list, but relatively small whenever you think of the scale of that spend, because that spend's so big. It's the equivalent of GDP of Sweden. So it's hard to actually imagine the scale of that spend.
Inflating prices for electrical equipment and stuff.
Absolutely. Well, it provides pricing power for these companies. They have to increase capacity. They have order books, some of them out to 2030. So a very strong position for those companies.
I'm not necessarily talking about any individual stocks here, but a name like Eaton, ETN, or something like that. Not necessarily meaning that company.
No, it is. Companies like Eaton. In Europe, competitor there would be Schneider. Company we hold in Japan, Hitachi, which is the leader in transformers and switchgear. So companies like that are really benefiting from the scale of the spend, and we've seen really strong results from US company like Vertiv deliver really strong results and perform well.
Are they a generator? What's Vertiv?
Again, into electrical and also into HVAC and into the data center space.
So these old industrial stocks are gaining big time here.
I mean, the market's on to that. They realise it. The businesses are doing very well, and it's quite unusual for an industrial space in that part of the industrial space to do so well.
What about the consumer stocks? Are you seeing bargains in North American consumer stocks at all?
I mean, you can't really ignore what's happening in the Middle East whenever you think about the consumer stocks. So, higher gas pricing, is a direct tax on the consumer, so that has an impact. I think when the opportunities that we're seeing are more in the defensive areas, companies that have been left behind. So you had a guest on talking about Walmart and Costco, so not companies like that, but other companies that have been maybe sold off in the last few months, where the ratings are low. And there's opportunities there to look for ideas.
What about the software names? We have seen a bounce in things like Thomson Reuters. I'm not even sure about Salesforce. That's been a poster child for companies being hammered. Do you see bargains in some of those traditional software stocks?
Yeah, I mean, the whole group's been sold off very aggressively, and it's been indiscriminate. And I think whenever there is a sell-off like that, there will be opportunities. The way we think about it is that AI is threatening these businesses in terms of their pricing power, in terms of the competitive advantage period. So you need to think and be pretty sure that the companies that you select, and there are opportunities there, that they will maintain their competitive advantage and pricing power. And those are good opportunities to pick up on.
Yeah, I mean, Thomson Reuters say we have exclusive data that lawyers need. I suppose you're looking for exclusivity.
Yeah, exactly. And I don't know Thomson's well enough, though. I also know Harvey's out there with an AI opportunity that's eating away at the Thomson's business. So there's definite question marks, and I think the market is onto that. The market was very willing to pay for many years into advance for Thomson's business, and now it's just shortening that right down. And I think that's probably fair.
Tell us, you're from Belfast, you're based in Edinburgh.
Yeah.
And so from a European-based portfolio manager, how do things look under the Trump administration? And without getting, get political if you want, but from a European perspective, I guess there's a lot of head scratching. What way is the White House going to go next on trade, for example?
Yeah, I mean, we've had tariffs, and tariffs have been a huge concern globally, but the equity markets have just rolled right through that.
Yeah.
I think Europe's in a difficult place politically. I mean, we can see that even with what's happening in the Middle East. Natural gas prices have spiked up hugely, more so than crude, and that has a direct impact on electricity prices. For the consumer, and that feeds straight into the politics as well. So, Europe is in a difficult position. It's having to rearm itself and confront the new norm that's there, and it's doing that. It will just take some time.
UK stocks, I see, as measured by the FTSE, up about 3% in the past year. So holding. Is there a lot of defence in the US, in the British index?
Yeah.
I can't even remember.
Yeah, there is some defence. The index is largely made up with pharmas, banks, materials, energies, and some defence stocks. So you do have BAE Systems as an example, or Rolls-Royce, and Rolls-Royce is a really a good example of a company that feeds into commercial, but also defence aerospace,
right,
but also into making turbines for data centres and the gas that's needed for that. So it's kind of a win-win for a company like that.
Johnny, thank you very much indeed.
Thank you.
Johnny Russell, Portfolio Manager, Global Equities at Amova Asset Management. On Friday on Market Call, we were joined by Paul Harris of Harris Douglas Asset Management. The theme was North American and global stocks. His top ideas: First Service, Microsoft, and Adobe. On the weekend, I said to my wife, do we have any Adobe sauce? I think I meant so. Now I'm blanking. What's the real? Anyway, never mind. I didn't want clay in my food. Today on the show, we have Bruce Campbell. He's president and portfolio manager at Stonecastle Investment Management. The topic is Canadian stocks. Chipotle, that's what I was looking for. Just ahead, we got 3 federal by-elections announced over the weekend. They are seen as pivotal because they could give the Prime Minister a majority government. Prime Minister said yesterday that by-elections in 3 federal ridings are set for this coming April 3rd. And these votes are pivotal because it could give the Liberals a majority in the House of Commons. Let's get more from CTV's Judy Trin. Judy, thanks very much indeed for joining us. So these could, in theory, put the government into a very bare majority. How important would that be?
Andrew, over the past few months with Conservatives crossing the floor, 3 of them did, the Carney government has been criticized for trying to get to a majority by poaching and not through what they considered fair means. Well, this will silence those critics if the Liberals are able to win all 3 seats. Now, the 3 by-elections are being held in 2 Toronto area ridings, Scarborough West, as well as University Rosedale. Those seats were previously held by Bill Blair and former Defense Minister and former Deputy Prime Minister Chrystia Freeland. They're considered safe seats. But the 3rd seat, Andrew, in Terrebonne, Quebec, that is a suburb outside of Montreal, that is going to be a really tough fight because in the general election, the Liberals only won that by 1 vote. And then that result was nullified by the Supreme Court after it ruled that it had to be it wasn't fair because of a mishap in terms of a mail-in ballot involving the wrong postal code of the election office. So that's where we're at. Expect the tightest race to be in Quebec.
And what are the real chances that the Liberals win? I guess incumbent governments often lose in by-elections, don't they? Because voters are just feeling ticked off.
Well, Well, it'll be interesting to see. I think what the polls have shown is that Mark Carney and the Liberals have widened their lead from the Conservatives. They are up 11 points. In terms of leaders, Carney has widened his lead over Pierre Poilievre in terms of preference by voters by 30 points, according to some polls. So you see that widening gap. So I don't expect that in the Toronto area that those two ridings will flip in any way. But I do think that Terrebonne, that we should take a look at Terrebonne, because the same two candidates are running against each other again. And because it was so hotly contested the first time, you can expect both parties to devote a lot of resources into winning it. So, but obviously, Mark Carney is hoping that this is the way that he is going to get to a majority.
Thank you very much, Judy. Judy Trin, our colleague at CTV News. Up next, we're getting back to oil. That's the biggest story in business right now. We're going to look at some of the scenarios and ramifications of crude at these elevated levels. One stock that's seen a bit of selling today is Bombardier, BBD.B. Now, I haven't seen the shares down about $10 to north of 230. I haven't seen any particular news. I wonder, though, is it part of people concerned that Middle Eastern clients might be cutting back on their private jet purchases with turmoil in that region? But Bombardier, a stock to watch. But as you can see, over the past year, it's done just fine, up around 170%. Right, so oil soaring today, a massive risk premium being built into crude with this fighting in the Middle East. BNN Bloomberg contributor John Ehrlichman has been tracking scenarios that market watchers are considering. John hosts the investing channel Ticker Take on YouTube. John, thanks very much indeed for joining us. Do a quick recap on the reality about oil price risk premiums, please.
Yeah, absolutely, Andy. I mean, a lot of people have been talking about the risk premium in recent days. And if you look back at the last 10 years, on average, what we have seen in moments of uncertainty that have pushed up the price of oil, give or take a $30 premium, that is part of the oil story. So obviously, ahead of the Iran war, we had crude trading at around $65. You've been talking all morning about this push above $100, which obviously is raising a lot of broader market questions, whether there's an inflationary threat. Goldman Sachs out with a note about whether or not a protracted war would lead to earnings deterioration for the S&P 500 companies, in part because of higher oil prices. But a $30 premium is what we have seen on average in the last decade. Now, a lot of people have been talking about 2022 with Russia's invasion of Ukraine. In that instance, we did see a peak $40 premium, but obviously everyone's been talking about the importance of the Strait of Hormuz. 20% of the world's energy supply basically halted. And so at this point, it does feel like a lot of people are prepared for an even greater premium than normal just when you look at the moving pieces of the oil story. But we'll see.
And what kind of scenarios are market watchers exploring and monitoring right now?
You know, it feels like there's sort of three main things that are, at least in the very short term, going to be watched closely. The most obvious one, you've been talking about it, guests have been talking about it, whether or not there is an off-ramp here, whether there's a way to de-escalate a situation that is making the world nervous. You know, with Donald Trump's tariffs, at the very least, there was an ability to pull back on that. Can you pull back on military conflict? Because the longer this goes on, in theory, elevated oil prices could be the reality. We're hearing about G7 nations talking about possibly making strategic reserves available. We'll see what kind of impact that has. But Andy, the other thing to watch is the point of demand destruction, which Bloomberg pegs at just over $130 a barrel. A reminder that we do tend to see a notable drop-off in demand once you get to that level, though that would be much higher than where we are right now. But those seem to be three scenarios the market's watching very closely.
John, thank you very much indeed. John Ehrlichman, BNN Bloomberg contributor. He also hosts the investing channel Ticker Take on YouTube. Coming up, oil surging past $100. What does this mean for markets? Our guest will break it down and give us their take. A group of 7 finance ministers are set to discuss a possible joint release of strategic oil reserves as the Middle East war drives crude prices sharply higher. The call was organized by France, which holds the G7 presidency and could include coordination with the International Energy Agency. A release from global stockpiles could help ease supply disruptions that have pushed Brent crude, the world contract, the global contract, close to $120 US a barrel, although officials said no decision has been made. The Prime Minister, Mr. Carney, and US President Donald Trump spoke yesterday afternoon, according to a statement from Carney's office. The leaders discussed the economy, developments in the Mideast, and trade relations between the two countries. Both agreed to remain in close contact. Shares in Hims and Hers are soaring today. The U.S. drug seller has struck a deal with Novo Nordisk to start selling obesity drugs. The partnership comes as something of a surprise after Novo sued Hims in February for launching a copycat version of its new Wegovy weight loss pill. And that's a linchpin of the Danish company's growth strategy. The drug maker at that time accused Hims of breaching the U.S. patents on the ingredient behind its best-selling medications, Ozempic and Wegovy. And there's a look at the TSX suffering today in line with U.S. stocks amid uncertainty of what the economic impact will be of this surge in oil prices. Of course, nobody has any idea whether it's going to be temporary or not. Let's have a look at the U.S. markets, and they too are suffering right now. After that weekend of rising oil prices that sent crude above $100, investors are watching closely to see how the market handles these elevated levels. We've got tighter global inventories, refineries shutting down in the Middle East. We've got an uncertain outlook, to make it, to put it mildly. We're joined now by John Zechner, chairman and founder of J. Zechner Associates. John, thanks very much indeed for joining us. I must admit, I was amazed to wake up this morning and yesterday seeing oil above $100 US.
Yeah, Andy. And in fact, I was looking at the futures last night, had them up over 20%, so they pulled back a little bit. But clearly the news over the weekend was more surprising. I mean, the ongoing bombing is continuing, obviously, by the U.S. and Israel and Iran. But the whole idea that, Kuwait, the UAE, Iraq, and now this morning, Saudi Arabia have all announced that they're going to cut back on oil production because there's nothing they can do with it. They can't ship it. It's not safe to ship it, and their storage is all full. So they're going to cut back. So even a tighter supply picture. And on the other side, yeah, you mentioned about, maybe a world release of strategic petroleum reserves. But, if the U.S. is trying to lead on that one, they're in bad shape. I mean, they sort of missed the boat on refilling storage in the past, 2 years or so when oil prices were weaker. They've only got 21 days. That's basically a historical low in there. So they can't really add a lot to the equation on that. The one thing I heard about this morning, Andy, which was shocking, is sort of decommissioning or some Russian oil production. Take them are desanctioning effectively.
Right.
And I thought, wow, that would be something. I guess if they really need supplies in a hurry, the Russian oil is out there. And I thought it goes back to the whole thing of the biggest winner so far in this conflict is Vladimir Putin. I mean, it's taken the eyes off what he's doing in Ukraine.
Yeah.
It's given him a higher price for the oil he is selling. And if he gets more of this, it'll even more. And then he'll continue on with his battle. So, I mean, there's a lot of geopolitical stuff going on right now, Andy, and markets are, having a hard time absorbing it all. You know what I found really interesting on Friday was they had that really bad employment number in the U.S. And I was curious to watch what happened to the bond market, because I thought the old thing is bad news, bad economic news, good news for the market. And I know the bonds actually sold off a little more. So clearly the bigger worry right now is the inflationary impact of higher oil prices versus any weakness in the labor market. And, that's got to weigh on stocks at some point, Andy.
Yeah, we were hearing talk of potential stagflation last week, a weak economy with prices still rising fairly briskly.
Yeah, I mean, it's, oil has caused some of the greatest pullbacks in the market. I mean, look at the oil embargo, the first OPEC of the early 70s. That led to probably one of the worst bear markets of the last 60 years. I mean, Desert Storm in the early 90s, even though it was brief, that was coincided with another sort of economic downturn and bear market in stocks. Not that it was solely responsible. Even more recently with Russia going into Ukraine. I mean, as you recall, 2022 was an awful year for both stocks and bonds. So oil is less of an impact in the overall economy. We keep hearing that than it used to be, but it's still an impact. I mean, particularly at the gas pumps and for the U.S. in an election year or sort of a midterm election year.
We have seen selling today in the copper stocks. Maybe we could have a look at Lundin Mining, LUN, or Hudbay Minerals, HBM. Concerns about the economic impact of this surge in energy prices, one of the reasons. Would you be a buyer of copper shares right now, John?
Got them on the radar screen. We had sold a lot, so I don't have a big weight in them right now. And the long-term story is still intact. But beyond what you've mentioned in the short term, sort of the strength of the U.S. dollar is recent strength is taken away from commodity prices a little bit in general. The copper inventories had built up pretty significantly too. So I mean, for all the talk about the long-term demand, it's in the short-term supply is there, even if there's not a lot of new supply coming on. So yeah, I've got a couple on the radar screen right now, Andy, but I'm not rushing out and jumping on those or anything right now. So, I mean, and then obviously we got other things going on in the market too, big, tech trades back and forth. And that was interesting last week. It was actually the best week for software versus semiconductor stocks ever. But that's after 6 months of brutal moves in the other direction.
It's interesting. Yeah, I mean, I know the software stocks are still down, but if we look at a name like Salesforce, CRM, it has had quite a sharp rally off the bottom, like other software vendors.
They really have. They got oversold, and maybe you just overdone in the short term. The valuations are very attractive. I mean, Salesforce, they had decent numbers. You look like a MongoDB. Adobe is coming out this week. Constellation was out today and was relatively good. So some of these worries about the SaaS apocalypse are maybe a little overextended. Markets take a narrative and they run it to the end zone in one direction very quickly without thinking about it. And I think that creates opportunities. And I think software will get impacted over the long term by this, but in some ways they have a lot of ways to enable AI in a better way within their own software, within their own ERP systems. And I think the stocks are really oversold on that basis. So we've been picking away in the names, and last week they certainly acted better.
You have been buying some Constellation Software, John, lately. They just reported this morning. I don't think there were any huge surprises in the numbers.
No, there weren't any surprises in the number. Yeah, we've been adding. In fact, I was on Market Call last week and actually put it as one of my top picks. Mm-hmm. And we hadn't been a big fan for a long time, for years, just because the valuation, 25 times operating cash flow for, 2 or 3% organic growth and completely driven by acquisitions. They were getting more expensive, but it always worried me. And now it's a bit of a different ballgame. It's trading at half that valuation. And in this sort of environment, Andy, I think this sort of plays into their game a little bit more. You saw the numbers in the quarter. They had more than 100% of their free cash flow went into acquisitions. I think for them, this is a good feeding time because there are a lot of good acquisitions out there, and they're going to start to continue to do what sort of made the company great in the first place. You're doing it over at half the valuation. And the other thing, not only have software valuations come down, but a lot of their competitors for buying these assets are private equity. And the problems going on in private equity and private debt right now, and the liquidity issues and all of that. So you may not see as much competitive buying from those, which really gives Constellation a good open lane at, like I say, at half the valuation. So, man, yeah, I like it in here. And I think, and the numbers, yeah, it's not a great organic growth. It never has been, but the acquisition strategy has worked. And now there's, more in play. And, for all the worries about Mark Leonard having left, it sounds like Mark Leonard's been involved pretty directly in this most recent attempt to buy Sabre down in Texas.
Yeah, that would have been a big deal. And the market apparently was relieved that they didn't push ahead all guns blazing on that because Sabre has quite a bit of debt.
Yeah, and they've gone more the buying private companies, small private companies with vertical market software and integrating them. That's been their game plan all along. So going to Sabre would have been certainly a bit of a change up. I mean, I won't say they won't necessarily look at other public companies if valuations get as depressed as they are in the private market, but it's not been the way they got their growth over all these years. That's for sure.
Thank you very much, John. Really appreciate it.
All right, Andy.
We're getting some breaking news out of the G7. The French finance minister speaking in Brussels saying that the group is not there yet. They haven't reached a deal on releasing oil stockpiles. And apparently the IMF, International Monetary Fund, and the International Energy Agency took part in a meeting involving the G7 finance chiefs. And the French saying, we're ready to take action to stabilize the markets, but we haven't reached agreement yet on releasing oil stockpiles. And you can see oil turning up modestly over the past few minutes, but up 14% today and comfortably above $100 again. Up next, more on the virtual closing of the Strait of Hormuz and what it means for global shipping. So that vital strait, Hormuz, virtually closed to traffic amid the Israeli and U.S. bombing of Iran, and then Iran threatening or even attacking ships in the crucial waterway. Let's get more on the conflict. We were joined by Andre Sire, Associate Professor at the Department of Management at the University of Toronto Scarborough campus and the Rotman School of Management.
Indeed, Canada is a net producer of oil, of crude oil, and it's benefiting in some ways. You can see that the price is also going to definitely benefit Alberta. But it is a paradox, it's a contradiction. What happens is that oil is a global commodity. And because it's a global commodity, it's going to be traded it's going to be traded by international benchmarks, international indices. You mentioned Brent, there is also the WTI. So even though we are exporting oil, we're definitely going to have to pay international prices for it. Because in a way, also we are importer of oil. For example, we still need to buy refined oil from the US around 30%, and we still need to buy internal oil for every purpose that we have here in Canada. So even though we are net producers, we just still need to import oil. We still need to buy international prices because it's a global commodity.
Professor, what's your view on the insurance system? There were chatter that there is potentially going to be government-led insurance to allow the ship to be carrying oil outside of Hormuz. How credible do you think that is?
I do think it's credible. I think there is a big effort in we heard this during the weekend, I imagine, that the United States is willing to provide some insurance. Because what's preventing one of the reasons that is the ships are not flowing through the Strait of Hormuz is because the insurance companies they are reducing the level of insurance, they are reducing their what they can cover at the moment, and this is definitely one of the big blockades at the moment. So definitely there has to be a negotiation with insurance companies, and I believe it's credible. If the situation persists for longer, it's likely that there will be some effort there by countries such as the U.S. to help that situation with insurance companies for sure.
And if the U.S. does do that, where does that leave the insurance companies? I mean, they don't want to send ships that run the risk of sinking and the disaster that would be. And I know they wouldn't have maybe be on the hook for the coverage of it, but they'd still be involved in this.
Right. So I must say that this has not yet been very well defined, right? There's still rumors and it's really complicated now to know. There's so much uncertainty, so many different levels in terms of the insurance. We only know that there is some discussions now. How is that going to work? I would imagine, if I were to speculate, which is a big mistake of my part probably, is that this would be a temporary solution. And definitely it's just to make sure that some flow is going out of the Strait of Hormuz for sure.
What's your view? So Hormuz is about, let's say, give or take 20% of global production of oil on a daily basis, right? So what do you think the GSET reserve, strategic reserve, can make up of that? My view is that it's not going to be sufficient, but you're the expert. So do you think it at least give us a few days, a few weeks in terms of supply?
Absolutely. There will definitely be... So when we think about markets, right? So we are in this situation now where we are cutting supply very aggressively because of the Hormuz closure. Virtually it's closed, right? It's 80% reduction capacity, and we have still demand at the same levels that we had before. So by putting more oil into the market, by providing the supply from the reserves, we can maybe improve supply a little bit so that we can try to reduce those costs. Now, I think that it can work temporarily, right? For sure, it can help reduce the price temporarily, but it always depends on how long this war, how long this conflict will continue. So if it continues for a long time, I agree with you, then it's going to be complicated. We're going to deplete our reserves. Another thing that can happen is this country is also going to start looking for other markets. For example, maybe Canada can help there. The only issue is that the consumers here in Canada would also suffer, right? Because we're going to export more of our oil. But at the very least, we know that Canada is this countries, they're going to look for more stable countries like Canada, where they can have some stable supply. So I agree with you. It would be a temporary solution. It would definitely help reduce some of the anxiety that we are experiencing. But in the long term, I'm not sure if this is the optimal solution.
And you mentioned with Canada being a possible source, but they also are going to look and go, Canada can't really supply Canada. We don't have the capabilities right now to get any more out of the ground, do we? Or minimal more?
Absolutely not. So Canada, as you know, we are on the west, we are big producers of oil, Alberta, as everybody knows. And on the east, we are just big consumers, right? We have Ontario, Quebec, everybody wants to consume those oils. And it's surprising that it's cheaper to import oil from the U.S. 30% is easier to import oil from the U.S. than from Alberta, and also refined products and refined oil products, derivatives, and so on. So we do not have the capability, and something that we have been discussing this last few years. And I hope this brings this discussion back to the top of our minds of how can we integrate the provinces, for sure.
And just how long would this have to go on in the Middle East and the Strait there with the shutdown for Canada to actually benefit, where people would turn to Canada and take a look? I mean, because a lot of people I think are looking, this could be over in 2 weeks, could be over in a month. How would it have to go? Would this have to go a year, and then people would start to want to invest in Canada with this?
I think because it would not be short. It would have to be a few months. I'm not sure if it's a year. It's just too hard to estimate at this moment. But it's a structural change, right? So it would have to take some time. And everybody's not, I think there is a sense now of not taking risks because we hear from the US administration that this would be limited in time. It's not going to be months, but at the same time, we hear rumors that it would take a long time. So it's similar to the tariffs, right? Everybody's concerned, oh, should I build the factory here or not in the US? Because I don't know if the tariffs are going to remain the same, going to increase, somewhat the same. We don't know whether the oil price is going to stay that high for so long. It is not good for multiple reasons that it doesn't, because for example, we are cutting supply to Asia by 70 to 80%, right? Japan's heavily dependent on the oil from the Gulf states. So we're going to start feeling the impact on multiple different products. So I don't think it's going to be hard for them to make the decision. Let's just change to Canada or to other countries. But I think it would have to be like this for a long time.
Okay, that was Andre Sire of the University of Toronto. And we heard during the interview there from our own Roger Peterson, but also Hadiza Jatou, Vice President and Portfolio Manager at Mackenzie Investments, who was our guest co-host today. Coming up, IA Financial CEO is on the lookout for acquisitions. That company hit a record valuation not long ago. That's ahead. IA Financial is gearing up for what could be a multi-billion-dollar acquisition push. Let's get more from Bloomberg's Montreal Bureau Chief, Mathieu Dion. Mathieu, thanks very much indeed for joining us. So IA Financial is thinking big in terms of growth?
Yeah, so we met with the CEO, Denis Ricard, recently just to better understand where the company was going after this quite large acquisition they've made in 2025. They've acquired RF Capital for $600 million. That included Richardson Wealth. And he said that he doesn't want to do, well, maybe he will do some, but he wants to do a big acquisition now. He doesn't necessarily want to target tuck-in deals as they no longer move the needle enough. So he's thinking in multi-billion dollar terms here. The company has excess capital of $1.4 billion. They could raise some debt. They don't want to issue shares for now, but they could raise some debt. So it could be quite a sizable acquisition. On the top of his list is probably a U.S. life insurance business in the U.S. 15% of their sales are in the U.S. right now, 85% in Canada. They also have other segments. They are in individual insurance policies, car extended warranties, and wealth management. They have an AUA and an AUM of $241 billion as of the end of last year. So there are several segments, but U.S. Life will come first. It's on the top list for now. So he's being bullish as the company reached a record high market cap in January, near $17 billion. The stock price is down about 18% since, but still, he's still bullish and he wants his company to grow.
I'm not sure if you heard. I'm sure you did hear about that Citrini research piece, with a scientific, or kind of a science fiction story set a few years in the future about what AI could do. And it's interesting. They claim that insurance renewables, where the entire renewal model depends on policyholder inertia, we just can't be bothered, was upended because AI created agents who reshop for your coverage all the time. So what does he have to say about AI threats or opportunities?
Yeah, and the AI threat also disrupt wealth management firms right now, as the stock price for these firms are also down because of this AI disruption thesis, right? He still believes in the value of advice. He still believes in the value of customer relationship. And I'm going to read you a quote here. People don't wake up in the morning saying, oh, I'm going to buy life insurance, or oh, I'm going to prepare for retirement. You may know some people who do that, but they're weird people. So he's not he's not saying that the AI threat does not exist. He thinks that AI is there to boost productivity, to better serve clients. The company, IA Financial Group, is investing $400 million per year in technology. They are invested in venture capital firms to understand emerging trends. But he really has this posture where he says, been there, done that. And if we think, for example, of Wealthsimple in Canada, the digital robot advisor, he's looking forward to see how profitable they are. And he said, I've been long enough in the industry to know that there are a lot of shiny new objects. And he referred to Wealthsimple as being a shiny new object. So that's his posture related to the digital risk.
Ouch. That's a bit scathing. Thank you very much. It is interesting, though, on insurance. Apparently, according to Citrini, people are just so passive about insurance, and that accounts for up to 20% of the premiums insurers earn. So I guess some people, the more tech-forward people, will have an agentic AI shop for things like insurance for them.
Yeah, but they could still buy insurance from IA Financial Group. So it's mainly insurance brokers that have been hit hard here by this report, from my understanding.
Thank you very much, Mathieu. Really appreciate it. Bloomberg's Mathieu Dion. Coming up, we are looking into a massive payday for one of the mining world's most influential families. The Lundins just keep getting richer. That's ahead. Let's get to some of the big stories we're bringing you from our newsroom. Saudi Arabia has started cutting oil production as the near blockage of the critical Strait of Hormuz starts filling storage tanks. The cuts by the world's biggest oil exporter follow similar moves by the United Arab Emirates, Kuwait, and Iraq. Some of these countries have been turning production lower so as not to overwhelm storage too quickly and avoid a complete shutdown of output. The near standstill has clogged up exports, sending oil above $100 a barrel and threatening a spike in global inflation. Shares in Xenon Pharmaceuticals are flying today. That pharma company generated positive results from a critical late-stage human trial for an epilepsy treatment and will apply later this year to market its drug in the United States. The company said patients taking a 25 milligram dose of its drug over a 12-week trial saw a 53% cut in seizures. North American stocks still under pressure with the threat of economic disruption and possibly inflation resulting from this surge in oil prices. Big traders in Toronto right now. Tourmaline Oil, the natural gas giant, higher by just over $1, about 2%. Suncor's up about 2%. AltaGas ahead about 4%. Canadian Natural up about 2%. Huge oil producers, you'd expect them to be up. Cenovus is also higher. We're seeing some selling, though, in the banks. Bank of Montreal, TD Bank, and Scotia all down about 2 or 3%. Right, let's talk about the Lundin family, one of the great clans in mining. They put less than $18 million into an outfit called Montage Gold back in 2024, not very long ago, and they've seen that stake explode in value, delivering a staggering return of about 2,000%. We are joined by Bloomberg Canadian wealth reporter Ari Alstetter. Ari, you have another great story. Tell us about how the Lundin scored on Montage Gold. It has a mine in the Ivory Coast.
Right. It turned out to be, I guess, a really far-sighted, perhaps well-timed bet they already owned a large stake of Montage Gold when they, in 2024, when it started building out its sort of flagship asset, this gold mine in Ivory Coast. It needed more money to actually get that project off the ground, so the Lundins provided it. Ever since then, as they've been building up this mine, I mean, it's made progress. And in January, it announced that ahead of schedule is actually going to begin gold production at the end of this year. Which, of course, is coming at a time when the entire market is just crazy for gold. Gold has reached historic highs in terms of price per ounce as the financial system seems to be changing under our feet. And that has been reflected in Montage's share price. Suddenly saying we'll be able to get more of this stuff out of the ground by the end of the year has seen those shares surge this year. And that's meant that the very low price that the Lundins paid for their shares when they were investing money to get the mine built has produced a huge return. They bought those shares at 70 cents a share. They're now trading about $15 a share. So you can do the math yourself. It's pretty big.
And as recently as January, Montage was drawing up estimates for the gold it had in Ivory Coast based on just $3,000 an ounce over 16 years. And of course, gold may well slump again.
That's true. They put conservative estimates for how much that gold is worth, but the basis for those estimates was $3,000 an ounce. So over the long term, of course, right now, gold's trading at $5,000 an ounce. So big change there, and really the key to that shift is suddenly it seems like the long-term structure of the financial system might have changed to support that price. When the mine was first being built out in 2024, when it was a mere twinkling in the Lundin's eye, the U.S. Treasury was still the bedrock safe asset of the global financial system. Now, since President Donald Trump has taken power in the U.S., people are starting to doubt that. They're starting to doubt that for the long term. So what other asset can be a bedrock safe asset? Well, the same one that's been there for millennia, gold.
Ari, thank you very much indeed. Really appreciate it. Ari Alstetter of Bloomberg. He's the Canadian wealth reporter. Coming up, we've got hot picks. We're going to zero in on 3 plays in autos. Time for hot picks, and we have one of our favorite watchers of the auto sector, Tom Narayan of RBC. Tom, thank you very much indeed for joining us. The focus is global autos today. Start off with a company called, I think it's Autoliv. It's a Swedish company, is it?
Yeah, Autoliv, it's Swedish, but it is listed in the U.S. I think it's a majority owned by U.S. investors. So they make airbags. And they are the dominant player in airbags. They have over 50% of the market.
Wow.
You don't have to worry about EVs or anything like that. Cars need airbags. Just a really cool mousetrap type company. We really think it's a special company.
That's interesting. I mean, I guess there's a moat, isn't there? There's huge safety regulations, et cetera. Hard to break into it, that market.
That's right. They have this strong moat. It's like the overall addressable market for airbags, surprisingly, isn't super big, but that creates an advantage, right? So if you're an automaker, you're not going to try to get into that business. You'll just leave it to Autoliv. And if you get the airbag wrong, I mean, it could be a disaster for you. So automakers are like, you know what, we'll just use these guys. We're not going to do this ourselves. And the number 2 guy that does airbags is way smaller. They're not as good. They're not as automated in terms of their production. They're actually trying to sell that business. So it's a really cool moat, like you said.
Your next idea, GM. Why do you think this is a promising one among the automakers?
Sure. I mean, automakers right now, it's a tough place to be. You're worried about the Chinese coming in, and even in China, there's competition. Europe is, there's a lot going on there. And so the cool thing with GM is it's really self-contained in China. That's not a big place for it to be. It is not in Europe at all. So you don't have to worry about the Chinese competition into Europe. And then in the US, it's like 60-70% of large SUVs. It's buying back a lot of stock. It has run quite a bit, but then the pullback now, thanks to the geopolitical situation, I think creates a unique opportunity.
And sorry, but they must be in Europe in some sense, just not in EVs. They're not in Europe?
No, they're not. They're not in Europe at all. GM pulled out of Europe. They used to be with, Opel and Vauxhall. They used to be a player there. But a couple of years ago, they pulled out completely, which probably been the wise decision thanks to all the competition happening there.
That's amazing. Because they had Opel for years, I think you mentioned. That was a great brand. And so they just abandoned the European market. And they couldn't even make SUVs or crossovers work in that market.
Right. Yeah, I think they saw the kind of what was going to happen in Europe with the competition there. Also, the CO2 rules are really stringent and strict there. So I think GM realized, let's stick to our core knitting, this like ICE, large SUV in the US. Which is protected, right? Like, I don't think the Chinese are going to come to the U.S. for a while. So I think they really saw the future and acted on it. And it looks like it was the smart decision.
And what are they doing now in electric cars? Can you remind us, or do they have a big investment program still in EVs in North America?
Sure. They were kind of later versus what like Ford did, for example, and that kind of helped them out. I think, Ford went aggressively with like the Lightning and the Mach-E, and there was a lot of competition. And now what we're seeing with all the policy shift in the U.S., that's hurting companies that really went aggressively EV. What GM did instead is do a flexible architecture. So on the same production line, they're making an ICE car, like a non-EV. They can also make an EV. And so what does that mean? Let's say EVs aren't in favor. They could just make more of the other types of cars. Whereas other companies, they have a plant that only makes EVs, and those are, facing some hard times. So they do make EVs, but they were kind of smart about it so they could pivot towards ICEs. You saw a lot of these impairment charges that the Detroit 3 took. GM by far was the smallest that they had to take because of how they engineered their manufacturing.
And so they have the Chevy Bolt with a B, and it's apparently rare. It's less than $30K in the U.S. market. Rare to get one below that price point.
Yeah, I mean, they also have the Equinox and the Blazer EVs, but they've really been deprioritizing that EV push right now for obvious reasons. And what they really want to do is really stick to their core knitting, right? Large SUVs, pickup trucks, the ICE business, and I think they're also going to benefit from the tariff change that probably is going to happen. They produce a lot in Mexico. So I do think a deal that the administration strikes there could be another advantage. And, if you're the administration right now, you probably want to strike a deal given everything that's been happening.
And then finally, something a bit racier, Ferrari. What's the attraction there?
Yeah, look, this stock has been, a monster success for years. And a lot of people, the biggest pushback we always get is, oh, wow, this thing is so expensive. And it has been, but it's pulled back a lot, right? Thanks to some of the geopolitical stuff going on. Also, they had an investor event in October last year where they tried to manage expectations lower. And the market really didn't like that. The stock really pulled back like 30%. So we think there's a cool buying opportunity here, a rare one. This stock rarely, pulls back a lot. It's just a great business. We all know what it is. I think that's a growth story. The ultra high net worth category is one that is growing. It's pretty economically resistant. What's happening at the lower end of the economy is it's really untouched for Ferrari, and they have a new car that's already selling today called the F80, which is a €3.5 million priced car. Super high profit margins. We think they're doing 800 of these over 3 years. When you run the math on that, it's hard to not like what you see. I think that the company is just trying to manage expectations. And like we've seen historically for this company, they always, to use an investor phrase, beat and raise, and I do think you're going to see more of that from Ferrari.
The F80. I guess if there was prolonged disruption in the Middle East, Ferrari and other deluxe car makers would feel some pain.
That is true. In the past, they did see there was oil shock in the Middle East. They did see a little pain on residual values, the secondary market, which does impact Ferrari. It's something we're definitely closely monitoring. I think the Middle East is about 10% of their car sales, though, so it's not the end of the world, but the residual values could trickle down overall. So something to monitor for sure. Hopefully, obviously, this is a short-lived geopolitical situation. If it's long-lived, then I think Ferrari would also be a company that would be impacted.
According to caranddriver.com, this F80, and they're putting a price on it of almost $4 million. This thing can get from 0 to 60 in about 2 seconds.
Yeah, it's a really special vehicle. It's also a plug-in hybrid, so they've invested in all of these technology that they leverage. Remember, this is a big Formula One player, right, Ferrari?
Yes.
So they use a lot of the R&D they spend on Formula One to effectively, juice up the performance of their vehicle. So it's not just a logo on a car, right? It's something more. It's a special brand. Not one that you have to worry about like maybe the luxury retail guys. It's kind of flavor of the month. This is something with staying power, with a rich history and legacy. One that we do think, like, anytime you see a really big pullback like we did see, a great opportunity to buy.
Apparently, according to caranddriver.com, the rear view camera is the only way to see behind you with this thing. I don't know. I would have trouble with that.
Well, I think that's a pretty common feature with a lot of cars nowadays.
Oh, okay. Is it?
I remember back a few years ago, the Hummer EV showed it, and I also found some difficulty with it. But like anything, you get used to it.
Tom, thank you very much indeed. Tom Narayan, lead equity analyst in global autos at RBC Capital Markets. Okay. There's been a lot of buzz about so-called humanoid robots lately. The idea is to have them help in the home. It's all part of the robot revolution powered by AI. And an Ontario company is part of it, using its own made-in-Canada machines and hoping for more domestic investment in the field. CTV's John Venevali-Rao has more in this report.
So this is MH3. This is our third generation humanoid.
Tarek Rahim was happy to show us his company's most recent humanoid, a made-in-Canada machine with arms, hands, and a head.
But this is purely Canadian. 100%, yes.
Developed in Cambridge, Ontario by Mercy Robotics, the goal is to start putting the so-called MH3 to work next year, initially doing repetitive and mundane jobs in industrial settings. The robot has vision and can locate and lift objects like this water bottle, placing them precisely where they need to go.
And that sounds simple, but it's actually very technically challenging to pull off.
And amid an explosion of AI-driven advancements, Rahim thinks something bigger than the automotive revolution is about to hit.
I can't wait for what's coming ahead. It's really exciting.
Recently, Kung Fu robots in China became a viral sensation, a flashy example of how fast the technology is moving. There have also been test projects with humanoids in the home, though many still need guidance from operators off-site. And it was recently announced that several of these people-like robots will begin working at a Toyota assembly plant in Woodstock, Ontario. They were built by a company based in Oregon.
It has been wild. The amount of interest and investment and competitors that have just emerged in the last 2 years has been mind-blowing.
Raheem has been working on robots for almost a decade, starting with this earlier humanoid, and now arriving at a third version that notably doesn't have legs.
Why not legs?
So legs actually don't make a whole lot of sense. They chew through power just standing, and they're inherently unstable, whereas wheels give you triple the battery life, and you cannot easily knock this guy over.
Mircea has around 10 employees, but plans to double that. All of the major components are built in Ontario. And with China surging ahead, Raheem thinks the federal government should do more to support the sector.
Now we're just seeing this tremendous growth because of all the interest in the industry.
With Mircea hoping to mass produce its own robot in the coming years. John Venevalley-Rao, CTV News, Cambridge, Ontario.
I love it. A Canadian robot. Coming up, one last check on the markets. Stocks under pressure. There's the TSX down almost 400 points. We'll be right back. Let's have a quick look at the markets before we wrap up the show. And naturally, we're seeing some strength in energy stocks today. However, the TSX Composite is down overall. It's not a pretty picture with the fear over what these $100 plus oil prices will do to the economy. We don't know how long that'll last, but presumably the Iranians with small boats can just create fear in the crucial Persian Gulf and just deter big shipping companies from operating. There is the TSX Energy Index, and you can see it is moving higher right now. I'm just looking at the XEG, the ETF that reflects just energy producers. And that one, of course, has been thriving, hitting record highs over the past few weeks. And I would not be surprised. Nope, not quite. It's not quite back to its 2008 level. There, the XEG. There are some energy stocks on the move. Strathcona Resources moving higher. I was curious. That's Adam Waters' company. It paid a massive dividend. So I'm not sure if that's distorted it, because my screen is showing it actually peaked in November, north of $43, but certainly moving up today. But on my screen, not hitting a record high. And we've also got Advantage Energy moving up. Let's have a look at Canadian Natural Resources, because that is, in fact, hitting a record high today, moving higher than its 2008 level. Investors just buying into those reliable oil sands year after year. They keep producing. Now, we've seen some selling in bank stocks today, and there's Brookfield down. I'm not sure if it's a perception, accurate or not, that private equity is suffering right now because the industry is so exposed to software companies, for example. So Brookfield down about 3% today. My screen is showing, though, still up about 8% in the past year. So people are still ahead on Brookfield, but it has been sagging lately. Its 2026 return down about 14%, and TD Bank down as well. Let's have a look at Constellation Software announcing, we jumped ahead there to the US markets, and you can see they are down, although it looks like they are off the lows of the day. The big traders right now in America, in dollar terms, NVIDIA is ahead, up around $1 or 0.5%. Tesla suffering, down 3%. You would think that higher oil prices would be good for Tesla. SanDisk is up. Those producers of memory devices are incredibly high traders every day. Broadcom's ahead, and I'm just looking here. Hims and Hers surging. That company we mentioned earlier markets drugs, and it has built a big franchise in selling versions of obesity drugs. They've actually struck a deal with Novo Nordisk, an erstwhile foe, and with an agreement to sell Novo Nordisk's weight loss drugs on its platform. Okay, we're out of time. Thank you very much indeed for watching. Morning Markets is coming up next.